Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary.
All right, welcome to the next episode of Lumida Non-Consensus Investing. I am pleased to be hosting Eric Jackson from EMJ Capital. Eric was featured in Bloomberg 2 weeks ago. He has been outside Drake's, his neighbor, a house with a billboard. I think it's like day 89. We'll get into this in a moment, and highlighting his stocks. Back in the day, 20 years ago, or I guess 40 years ago, it used to be the hunger strike is how you got attention. Now, in the age of the modern influencer, you walk in front of Drake's house. So we're going to talk about how social media has transformed investing, idea generation, underwriting, approach. Meme stocks, are they good or are they bad? We're going to talk about Eric's background too and your ideas. We're both investors in Better Mortgage as well. We're going to talk about how you got Keith back on the board of Opendoor. There's a mix of social media and activists going on there. So a lot to get into. Eric, thank you for joining. Let's start off with Drake. So how did you get in front of Drake's house? And by the way, it's going to start getting cold now. You fall in winter.
It was 48 this morning. It was day 59 this morning.
You noticed, huh?
Yeah, I actually wore flip-flops because
okay.
I'm Canadian.
Flip-flops.
I typically do these now at 7 a.m. That's been like mine. And today I had a guest, it was like a walk and talk now. I've done like 3 of these and the 2 of the 3 have been students who've asked to come and meet me there and walk along and talk to them and stuff. We got some good feedback on the first student, so I had a second one today. So it was.
When you say student, do you mean a student like you're teaching a class, or they?
No, today was a guy from University of Toronto. So he's like in the second last year of college. I'm trying to remember his name.
Sure.
Praval or something, I think was his name. Anyway, and then it was earlier this week. It was another university student from Montreal. He happened to be in town for the weekend, and so he asked if he knew someone who I had met who was a member of the Open Army down in New York, because he is a football running back, and this other guy used to be a running back for the Falcons last year, the Atlanta Falcons, but now he's like rehabbing, and so he's like trading stocks, and he has like a faith-based podcast that he's using to build up. So anyway, it's 6 degrees of separation type of thing. And people, definitely the younger generation, are a strong constituency of both the Open Army and now what I call like the bigger rising dynasty is the term I use to describe the movement of people who are supportive of Opendoor, but like some of these other stocks like Better and several others, because I think it's just bigger than Opendoor itself. And I think part of the retail movement that we've been able to build up over the last few months is there's some commonalities in them, and it crosses geographies, which has been surprising to me. Like, it's all over the world, but it seems to be like there's a middle class out there who is very hungry to improve their lot in life financially, and they see stocks and stock investing as a way of doing that, not as a get rich quick type of scheme, but there are legitimate opportunities in the stock market for 10xing your money, 20, 50xing, hopefully 100xing. And that would be life-changing wealth, generational wealth for a lot of people if they hit on just one Opendoor, one Carvana. Carvana is like the poster child here for.
And that was your first using of social media to highlight this opportunity.
First 100x kind of an opportunity.
Okay.
20 years ago, I was involved in a social media campaign against Yahoo. And I spent like 10 years of my life like banging my head against the wall with dealing with the Yahoo board that was like the epitome of asleep at the switch. And that as they cycled through 5 different CEOs, Marissa Mayer being the last one who drove the company straight into the ground and then popped up and claimed victory for it, passing off the keys to Verizon to take it over. So I've had experience with social media, and I know that you wanted to touch on that.
Yeah, definitely.
But the Carvana was a case of a stock that went from $400 like in 2020 down to $3.50 in December 2022, and then came all the way back to recently. It was like as high as $413. I think now it's pulled back to $350, $360, something like that. So but that, like, I was an early kind of long, I guess, in that comeback. Like I had an AI model, and kind of a nascent AI model that flagged it at $11 a share in May of 2023. And so I wasn't sure that the model was right. So I asked the guys working for me at the time to check it over, because it said this should be like the number 2 long position in your portfolio. And so a week later, they came back and they said, no, yeah, it's accurate. You should go all in on Carvana. And by that time, it was $15 a share. And so I did go make it a significant position. And then a couple of weeks after that, I got invited to be on CNBC talking about Tesla. But I ended up like steering the conversation halfway through the interview towards the direction of why I thought AI is going to revolutionize hedge funds as well as every other industry. And, how my new AI model had flagged Carvana, and why I thought that was interesting, because I thought if I was a typical guy at a typical hedge fund who had 20-something MBAs working for me, on a Monday morning meeting, I doubted that someone would have the cojones to bang the table and say, we got to go all in on Carvana because for career suicide concerns and all this kind of stuff. And yet the computer doesn't care. The computer just wants to give me the best answer.
And your AI model, was that GPT-5 plus a prompt and a data source, or what was this AI model?
The model was based on gradient boosted machine.
Oh, it's a real machine learning algorithm. Yeah.
So it's like a machine learning. It was a much more technically driven model, that first iteration of the first model. So it was going off of things like capitulation volume signals. What's the ideal like moving average for Carvana? Was it above the moving average?
Oh, I see.
And that's a different moving average than the one that works best for Apple. Things like that. So there were like a bunch of technical signals that were firing off, saying that Carvana had just recently moved in this sort of upswing and that you should take a position. Since then, we've played around with all different kinds of other features to build our models with. We had like more fundamentally driven features, insider buying, insider selling, social media activity, option models, earnings models, crypto models, and stuff like that are more macro models. So we threw a lot of spaghetti at the wall subsequent to that first Carvana model. And a lot of this stuff didn't work or didn't work well. And I had a lot of choppy performance, some great like 40% months, and then followed by a down 60% month.
That's called auto sample testing of the model.
It was. So earlier this year, I suffered like a huge withdrawal at the end of 2022, where like this billionaire who had given me my start 10 years ago basically redeemed out of the fund after a down 21 and a down 22, because before then I'd been more like of a fundamental, like bottoms up stock picker focused on growth tech companies. So I was like made a lot of money on Twilio and Roku and Carvana, like in the 2017 to 2021 stage, and had done really well. But then all those companies got murdered in 21 and 22, and I was like too heavily weighted to them, had too many options in those kinds of names, and had a brutal 2 years. And so the billionaire said, thanks a lot, I'm redeeming out. And he was like 99% of my age at the time. And like I always dumbly always thought like he'd be in my back pocket and he'd be with me through thick and thin, like a marriage or something. But everyone makes their own choices and stuff. So he was gone. And so then I had to scramble around figuring out what my go forward strategy was going to be. And I had all these expensive people around me I was paying money to, like lawyers and Cayman's fund directors and other people, basically telling me I had to shut down and I wasn't viable anymore. And I had this like spotty track record that I'd never raised money with again, because nobody wants to invest in kind of an up and down track record. So I should just like close my shop and then wait 6 months and then pop up again, start a new fund where I didn't have to show my like spotty track record.
That's what most people would do.
Yeah, that's like the game, the road for most hedge funds. I didn't want to do that, so I just bumbled along, and I was building all these models in these last 2-3 years. And then earlier this year, I don't have like endless wallets to keep paying all these engineers. So I was like, guys, we've got to stop doing 8 different models. I'm just let's like focus on the two that show the most promise. And one was a crypto model, and one was this 100-bagger kind of model that we had used with Carvana and that we tried to iterate on since then. And so for the main hedge fund, we're doing the 100-baggers. I have a new crypto treasury company that hopefully is going to start trading in a month or so. And so that's going to be where the crypto models live. But that's a position we took early this spring. And then our first two ideas out of the gate for future 100-baggers was Iron and Cypher, which I took positions in. I think it was in late May, early June, and then announced them on Twitter. And I noticed like right away, people were like, oh, wow, the next Carvana. Oh, I missed Carvana. Good job catching Carvana before, Eric, but I didn't pay any attention. I'm not going to miss the next Carvana. And so suddenly, like my Twitter follower count was like 30,000 for the last 5 years. It hadn't really budged at all. And then all of a sudden it starts going up to 31,000, 32,000 and stuff. And I noticed just a lot more engagement from people about the next Carvana. And then some people started asking me, hey, weren't you on a podcast 3 years ago where you talked about like how you thought Carvana was going to come back from the dead, which is true. But that was like 6 months before it bottomed. So I was wrong for 6 months, and then it finally made the turn. But in that same podcast, I had said I thought Opendoor was going to make the turn as well. Both Opendoor and Carvana were going to come back from the dead.
A lot of stocks are quote unquote making the turn, and a lot of hedge funds are offsides, shorting into this. Quantum stocks are an example of that. There's another article, I believe, from Bloomberg too, showing just the long short strategies lagging and hedge funds being offsides. And as coming off the April bottom, it was really retail investors that led the charge and did very well from buying the dip. And hedge funds have been offside and frustrated, I think is maybe the word to use here. You got Martin Shkreli, who's not at a hedge fund, but comes from a hedge fund investing background and shorting IonQ and quantum stocks. And I'd also be of the view that these are bubbles and they don't make money, but there are other opportunities out there that are mispriced. So could you elaborate just a bit more on what's happening in this dynamic? Is it retail investors and social media that's causing this kind of short squeeze? Or is there some other market dynamic that's not understood by the hedge funds that they're getting wrong?
I think one is that I think retail investors are smarter than they get credit for. I think they constantly get talked down upon by Wall Street people, including all the anonymous Wall Street bros who have accounts on Twitter and sometimes they're legitimate, like people that work within hedge funds. Sometimes they just portray themselves that way, and they don't really. You can tell if you start to dig beneath the surface, they don't understand it. But they're always talking down on retail. I remember like this funny story. One of my daughters had a leak in her bathroom in January, and like water started pouring down through the ceiling into our kitchen. And so I hired this guy to come and paint the ceiling to cover up the water stain. And he started asking me about this quantum stock that I had tweeted about called BTQ Technologies. And I quickly, and he was long BTQ as well, which at the time was like an over-the-counter stock. It was only traded in Canada where I had bought it. And then now it's just a month ago, it got uplisted to NASDAQ. But he was in BTQ in January. Okay. And I realized as I was talking to him, he knew pretty much as I did about post-quantum cryptography and like all this, the reasons why BTQ was well positioned and stuff like this. And so it was a bit of an aha moment and I've met lots of other people like this as well. They make money in their jobs doing whatever they're doing, painting, plumber, electrician, whatever. But they really see stocks as a sort of important place where they got to spend an extra 3 hours a night to potentially really jumpstart their own personal situation. And so I think they're a lot smarter than people think. I think in hindsight, they've been highly rational in piling into quantum names. So I differ from, I don't know, the Jim Cramers of the world who try to warn you against getting into quantum stocks and instead want to steer you into getting into CRM, Salesforce, which he's constantly flying out there, going to Dreamforce, talking about how great Salesforce is. I pulled up the 5-year chart on Salesforce. Salesforce is down 8% in the last 5 years. Okay.
Yeah, no, I agree. Salesforce is an incredible commercialization machine, and the CEO, Mark Benioff, is effective at Twitter at positioning the company around AI. But I think a lot of these SaaS players have a lot more at risk with the rise of AI when you can re-platform quickly, and the risk of the obsolescence is very high. Obviously, you've seen that with Adobe stock And then we've talked about that too. And
Yeah.
You've got Midjourney that can spin up an image on the fly, or OpenAI can do an edit on the fly. And even just a phone, you can do a magic lasso and modify on your mobile in 10 seconds. So you're seeing that priced in. So I'm showing on the screen here, but this is Renaissance Technology. So not all hedge funds are responding the way you and I were discussing a moment ago. This is Renaissance Technologies, one of the most famed, secretive, and successful hedge funds of all time. And you can see their top holdings. This kind of reads like a retail investor momentum Twitter portfolio. Palantir, top position. Now you can see they're selling that down. If you look at the ownership history, I think that's a wise decision. NVIDIA, Robinhood, VeriSign. VeriSign is more institutional. Netflix is in there. EXEL. We own EXEL, by the way. So the point being is that I do believe that there are hedge funds that are incorporating algorithms. Obviously, momentum factor is a part of that. Renaissance's first factor, it's been reported, which they found in the 80s, was momentum. They've since elaborated upon that. But the other is social media. They also have Reddit. If you look deep down in the 13F holdings, they own Reddit. Now, I'm a trained CFA charter holder. I can tell you the CFA curriculum that says you're not supposed to own Reddit. You're not supposed to own Palantir, because value is what you pay for. Value is what you get, right? Mm-hmm. But here you have some of the most sophisticated hedge funds in the world that are banned social media. Social media stocks, do you think that in the wake of GameStop, in that moment in time, I think the consensus view was, hey, this is a kind of a crazy blip in history and you don't want to be a meme stock. Has that changed? Did meme stock go from villain to hero, where success is that your stock becomes a meme stock?
No, dislike it when, like, Opendoor, for example, gets called a meme stock.
So it's pejorative in your mind, the term meme stock. Okay.
Yeah, I would never want to own GameStop stock. Okay. Even if you gave me $1,000 to go buy the shares,
you would sell.
Why would I ever want to? I don't have much respect for Brian Cohen, and I don't get their strategy now. They're going to be a Bitcoin Treasury trading card company, or digital trading card, or whatever. So why would I want to? And then dying a retail business. Okay. So then, what are the other examples of that? Were
Reddit, another one. Reddit, they're licensing AI. There's an AI story there. Palantir, but the valuations are bananas, even if you control for earnings.
Well, yeah, I don't think Palantir was ever considered a meme stock. I'd say it was more like cult stock.
Yes.
And I can only think of, maybe Reddit was a cult stock, but really Tesla at the end of last decade was a cult stock. You'd go to a party and half the people would think Elon walked on water, and half people were like the Tesla Q crowd that said it was going to go bankrupt and all this. And the bulls were right. And then the same with Palantir. All the value CFA types said, this is so expensive, and it's just a defense contractor, and on a forward price to sales basis, it's 90 times or 30 times or whatever it was. It's ridiculous. It's going to end in tears. And then even at $5 a share, they were saying that like it was too expensive. And obviously they were wrong.
I was in that bucket in the wrong hand.
I think there's a big difference between a value mindset investor and a growth investor. A value investor would never have invested in Carvana at $3.50 in December 2022. And a lot of people loved piling on Carvana then and calling the management team a bunch of criminals because Ernie Garcia Jr.'s dad did some deal with the SEC in the 90s around the SNL crisis or something like that. And therefore,
there's a great quote from Stevie Mandel, founder of Lone Pine Capital Management, one of the first Tiger Cubs legendary investor. And he says, I don't need an analyst to tell me that a 10 times PE stock is cheap. I need an analyst to tell me that a 40 times PE stock is cheap. The point there saying growth stocks, you have to do more analysis around to see whether you're paying appropriately. So I get fair distinction, meme stock versus cult stock.
He's one of the best growth stock investors. Lone Pine, Chase, Coleman, although
that's Tiger, of course.
Tiger, and then Co2, obviously. Those are probably the top three I can think of.
I would say Whale Rock. I'd put Whale Rock ahead.
Whale Rock, yeah.
I think Steve Mandel is one of the best, no question.
There's one in Hong Kong too. I forget the name, but they're really good too. Anyway, it's a different approach. But so that's one thing. So I'd say the growth, the memes. I don't think anyone should aspire to be a meme stock. I think it would be great if Opendoor became a cult stock. It would be great if they consistently got a permanent premium multiple the way that Tesla did. And
I'll say there are others. What about Walmart and Costco and Berkshire Hathaway? Berkshire Hathaway, I'd argue, is the ultimate original cult stock, traded at a premium.
Right.
Now it's sold off considerably after Buffett announced his retirement, recovered somewhat. Costco's at 45 times earnings. I'd argue that those are institutional cult stocks. Right. So cult stocks are not a new thing. So would you say that, okay, let's draw the distinction. Meme stock, not a good thing. Got it. Cult stock, is that an appropriate aspiration?
Sure. There's a whole bunch of consumer product goods companies that you just mentioned some. Domino's Pizza, for example. Like I looked this up recently because I made this sort of a joke of it on Twitter. No, like every time you turn on CNBC now, they're talking about an AI bubble, but nobody's talking about the pizza bubble. And yet, like Domino's Pizza trades at this permanently high PE, which according to all the talking heads on CNBC is a big warning sign right now because all these AI stocks, which they never defined, by the way. I'd really like to hear where's evidence of this AI bubble? Because I think most agree NVIDIA is not in a bubble, at least historically, from a forward P to EBITDA multiple basis. It's actually probably the 20th percentile of where it's traded in the last 5 years or something like that. And what are the other examples of that? I don't know, Palantir maybe, but right. I think it's more of that falls into the cult stock category. Anyway, yeah, you're right. There are these certain consumer product goods companies that permanently trade at this high forward PE. So I don't think there's anything harmful in the fact that Palantir people have been right. I mean, that it deserves this premium. Now I missed that one, but do I want to pile into Palantir now at $500 billion market cap? Me personally, no. So I'd say congrats to the people that nailed that trade. And I'm looking for the next one, like whether it's Opendoor or BETR or whatever. We can talk about some of the Iron and Cypher and all that sort of stuff. Now, is social media different today than...
Is it a part of the underwrite? Is it an essential input to underwriting a stock? And have institutional investors missed the boat on this?
Yeah, like the truth is that social media buzz is not a great feature to build into your future machine learning model about these stocks. It doesn't mean anything, at least when you look over a bunch of different examples. There's always some like hot new stock that seems to bubble up on Twitter. And just because that's the case doesn't mean that it's going to be a good predictor of future outperformance. So I think the other thing that is missed in my example, I guess, at least with Opendoor, is the importance of leadership. Of some, like the Herd on the Street from the Wall Street Journal wrote this article that I took offense to, because they dumped on Opendoor. They took the value investors mindset, and it was like a color by numbers.
They pattern matched in the wrong way.
Yeah, it's like they've never made money, therefore they never will make money. iBuying failed before. Reddit, not Rocket, the other company, Zillow, and the one that Rocket bought, like pulled out of the iBuying business.
Coop, Mr. Cooper.
No, not Mr. Cooper. It was like the other brokerage company up in Seattle.
Got it. It was the iHome buyers, essentially.
Yeah, iBuying is a failed model. Yeah. So that would be like saying, like when Steve Jobs came back to Apple, well, they never made money, they never will make money. It's ridiculous. Like it's pure like rear view mirror driving kind of prognostication. And then they said, but the other thing that kind of bugged me, they didn't mention me at all in the story, but they sort of mentioned that there had been this open army, this amorphous open army, which had congealed out of nothing and then suddenly forced the CEO to quit and all these other actions and Keith Raboy to come back on the board. So it just happened. The army just emerged out of nothing. I don't think that's what happened. Like there was one person, i.e. me, like leading that and inspiring people, I think, and pulling people together. And I guess that happened with GameStop with Roaring Kitty. I don't know why AMC would probably be a better example of the mob suddenly like just going behind one particular stock. But I think my point is that it still takes leadership to harness the power of social media. And somebody has to be that voice and kind of be willing to take the slings and arrows in the back from all the trolls online.
So you did social media activist investing, essentially. You agitated for change. You identified an opportunity. When were you building your position? Maybe it was a little bit before on the idea that, hey, maybe management will get it. But at some point, you started seeing these inflection points. You getting Keith on the board was a huge win. So as you're starting to see momentum build in your approach, how are you building your position? Were you investing when they had the wrong management team, for example?
Yeah, my first tweet about Opendoor was on July 14th. It was a Monday, like 2 p.m. And I built my position before that. so in the couple of weeks leading up to that, after people started asking me online, hey, whatever happened to Opendoor? And I realized, oh yeah, I haven't looked at Opendoor in a while. I want to take a look again. And I started to get excited and feel within those 2 weeks before the 14th that, oh, I think we could be hitting on Opendoor more similar to close to the bottom, like where I got into Carvana at $15, not $3.50. I was like, whatever, 5 or 6 months later than the bottom. And hitting things at the bottom is obviously, if you really want a 100 bag, step number one is to nail it at the lowest possible price, because it's obviously
you're catching the falling knife at that point, though.
That's the concern. It's like, right. In June 22, I had said on this Compound and Friends podcast that people should get into Carvana. And back then it was like a $20 stock. It took another 6 months. It went from 20 down to 350. So you were down like whatever, 80% on that, if you'd followed my advice on that podcast. So that's the falling knife risk. But if you nail it at 350, then, obviously you're up 100x right now at $350 on Carvana. And so I felt like Opendoor, it had the potential to come back. It obviously had like really done some bloodletting. There was like a lot of capitulation selling. It was below $1. A lot of ETFs were forced dumpers that they had to get out of that position. Anyway, and you knew that the macro environment, there were going to be cuts. Nobody knew in July. Nobody knew if there was going to be a surprise announcement at Jackson Hole, I think there was a potential for even a July cut, like in the third week of July or something. But although it seemed unlikely, you didn't know if it was going to come in September but it seemed like before the end of the year, there were going to be cuts. And obviously that's a big accelerant to a business like Opendoor or Carvana or all these other kind of interest rate sensitive businesses. Like with Opendoor, there's just a flood of increased activity as the mortgage rate drops in housing activity and all this kind of stuff. I felt like the macro was going for Opendoor. They had done some cost cutting from that current CEO. So I was like undecided about the current CEO when I announced my position. I felt like I hoped it would one thing that was not the case at Opendoor, that was the case at Carvana, was Carvana's several members of the management team and the board were buying shares like crazy in 2022. And Opendoor was just the opposite. They were dumping shares through these 10b5-1 insider every month, selling more stock. Even at Opendoor got as low as 51 cents a share on June 25th. And at 56 cents a share, Carrie Wheeler, the CEO, was selling shares as part of her 10b5-1 plan. So that wasn't a good look. I didn't like that, but I held my nose. And like, it's the thing is, most executives at most companies sell. And people like to tweet about it on Twitter and say, oh, they don't have Jensen Huang. He dumped another billion shares. He's been dumping shares constantly. Hasn't been a sell signal at all for NVIDIA. So most of the time you can just ignore the selling. And I just hoped that this was a case where hopefully the turnaround, the cuts that they had made in their business to their headcount, they were hinting they were going to be at least EBITDA positive and for the first time in 3 years on their August quarterly results. And they were. And so that's one of the preconditions to a stock coming back like from the dead, is that you've got to get to sustained profitability. And it wasn't guaranteed that Opendoor was at that sustained point yet, but usually the stock bottoms like 6 to 8 months before it proves sustained profitability. And so that's part of the risk.
Yeah, markets are looking forward.
Is like, if you really want to catch the bottom, you can't wait for proof that they've turned the
business. You were waiting for non-consensus, all the worst news is priced in. You think capitulations in your rearview mirror. You're making a bet on some kind of improvement. And the macro thesis was mortgage refinance, rates coming down, which also links back to your better mortgage thesis.
Exactly. But within a week, I was also aware of Keith and the fact, if you'd asked me when I first tweeted on July 14th, Eric, what's your dream scenario? If everything goes right and like blue sky, like what would be the cherry on top of a comeback story in this company? And to me, it would be if Keith Raboy came back onto the board was welcomed with kind of open arms again. He wrote the original business plan for Opendoor. I think he's like the smartest guy in the world of tech. Obviously, everybody has, I guess, their own favorite smartest person, but Keith is it for me. And and he's got a certain amount of pixie dust attached.
Yeah, he'd be the best addition to the Olin pod. I think he's very insightful too.
Yeah. And if a guy like that is part of the board, it's like having an Alex Karp as your CEO or an Elon Musk. You're gonna get some sort of shine onto the stock with someone like that, and he's going to make sure that the right people are involved and so forth.
Yeah,
that was my hope. And I knew he had a soft spot for Opendoor, obviously, but I also knew he had left the board. He was bitter about it. I didn't realize like how much he hated the current CEO of Opendoor. So that became apparent like a week into my tweet, and that was a bit of a concern. Oh, gulp! This isn't great. And then in early August, I heard this earnings call from Opendoor. And that really soured me on Carey as the.
And you're already long and strong the stock at this point.
Sure, yeah.
You're getting bad incoming data that's falsifying your thesis.
Right.
But you're taking some actions to try and fix it. Go ahead.
So you said before, oh, Eric, you're a social media activist investor. That's not how I thought of myself. I mean, like the ideal, like I hoped Opendoor was going to be like Carvana, where great CEO, great management team. You just sit back and let the turnaround happen and let the 100x roll in. But like when I heard a week before that earnings call, I had some conversation with this guy named Adam Bain, who's on the board of Opendoor. He used to be the head of sales for Twitter. Then he became president. So now he's a venture capitalist with Dick Costolo, who was the CEO of Twitter. And they have their own VC firm. And then they made an early investment in Opendoor. And so Adam's on the board. And Adam saw my tweets where I said, hey, I think Opendoor could be the next Carvana, because it was like, I built my position around like 73 cents a share. When I announced it, I think the stock was 88 cents a share. And I said, I think this could be an $82 stock in 3 years' time by 2028. And Adam DM'd me, and one of his first thing was like, really? Are you serious? Which to me suggests like he didn't really see that himself, which is a bit concerning from the people that are on the board. Like I would hope like everybody on the management team and the board is like sitting there thinking like, oh, the market's getting this wrong. We are truly like this multi-billion-dollar company and we're going to be successful. But I had some conversations with Adam, and I said, like, at least, so 3 weeks into this tweet campaign, I mean, there was a lot of support. A lot of people were excited. The stock had rallied. Like 10 days after I announced my first tweet, the stock got halted because it had gone from 88 cents to $5. And it got halted on a Tuesday for about 13 minutes because they traded 2 billion shares that day in Opendoor stock. They only have 700 million shares outstanding. And like before I started tweeting about them, I think they were typically trading, I think it was like 35 million or really small. It was like you had to make an appointment to trade the stock. And suddenly there was this incredible enthusiasm. And then the halt spooked a lot of people. And so immediately, like when it reopened at 3:15, it was at $3.50 a share. And then for the next week or so, like people were losing confidence. The stock went down to back to like $1.65. Which is still a double from when I first tweeted about it, but a lot of people came in late, and then now they were underwater on their position, and they were pulling out, and I was getting tweets like, "You got to do something, Eric. You got to tweet something. Get the stock price up. You idiot! I put all my like life savings into this stock at $3."
You're getting the haters at this point because they showed up late after the momentum showed up. So you're in the gains. Right. Now they're upside down. There's more volatility.
So I said to Adam, like a week before the earnings call, I said, Adam, you got to make sure. Tell Carey to do an earnings call the way Alex Karp does it at Palantir. Make it a video call.
Like a Sports Center debrief.
Yeah. So make it video. Show that show who you are. Don't hide behind audio, which is what most management teams do.
Right.
And take as many questions from retail as you do from the sell side analysts, because there aren't very many sell side analysts who still cover this company. And B, like show that you're really open to feedback from retail and that you want to embrace this like open army. And he said, yeah, it's a great idea. And then either he didn't tell Carey or Carey didn't listen, but it was like a 30-minute audio-only call from start to finish. And probably 20 of those 30 minutes, or maybe even more, was either legal boilerplate or like just prepared remarks, right? And so the Q&A was like very brief. And Carey mentioned AI a couple of times, but in a very superficial way, right? And so you'd think this is a business, if this is going to be like the Uber of selling homes, like AI is going to be critically important. And she just didn't have anything to say on the subject. So after that call, I knew that like my years at dealing with Yahoo was that like giving Marissa Mayer more time as CEO was just the wrong thing you needed to do. You needed to immediately rip the Band-Aid off, get this terrible CEO out of the position, and get an effective CEO in the shoes. And I just like immediately flipped to becoming this, like, she's got to go, and Keith has to be put on this board. Keith should be like the head of the CEO selection committee, and he should pick the next CEO. And again, got lots of hate, lots of people saying, you can't say that. You're going to tank the stock. This is terrible. And the worst were the people on either the subreddit community for Opendoor or the Discord community. They're the biggest babies. And I get like all these people saying, I had one person on the Discord server for Opendoor saying, you need to apologize now. You need to write a letter of apology to Carrie, and you need to get her to accept it and publicly say that she's accepting you. And I was like, forget that. Like, I'm not married to her. Like, I'm a shareholder. Like,
you're adding accountability to the conversation.
So anyway, long story short, Keith did end up coming back, and it was a package deal. Like, he was working on getting Kaz involved as the CEO. And I think he went to the board, like, a take it or leave it offer. Bring me and Eric Wu, who is another co-founder, bring us back on the board and bring Kaz as the CEO and give Kaz like a performance-based comp package, or we'll basically make fun of you. And
Got it. So ultimately, and briefly, and we'll move on to better, but from a governance standpoint, you influence the board, and social media pressure influence the board, because obviously they control whether the CEO is in the role or not, and the board agreed with this proposed approach, which came from the community.
Yeah, I think the board, I met with the board. I was out in San Francisco. I had a meeting with 3 of the board members. So I think they knew that there was a lot of noise externally. I was a voice of this noisy retail shareholder base. And then they also had Keith out there. And strategically, obviously, I wanted to lock hips with Keith. A, because like I said before, I felt like he was the smartest guy in tech. But B, the game that the Yahoo board always tried to play with me is, you're not a long-term shareholder. We have the long-term interest.
They dismissed you as a hedge fund that's not in it for the long term.
You're just here for the quick buck, and you're going to be out. And so I knew that they couldn't say that if I was like locked at the hip with.
You had the credibility with Keith, exactly. As you were aligned. So it was very hands-on. It was social media. You worked the board. You talked to 3 board members. You were in town. So there was a lot, not just in social media, but in real life, to drive the results. So let's shift gears to Better. We both know Vishal, and we're both owners of a Better stock. And by the way, actually, it's very similar to your thought process. We interviewed Vishal on the very same podcast that you're on right now back in December 23, which is right here, if you can see the screen. We started buying here at these green lines. So we waited for some technical evidence there. And then you got on board. And I was like, Eric Jackson's my best friend. I'm sending you a Thanksgiving gift basket. I want to put your kids through college. I guess they're probably empty nesters by now. We'll send you Drake albums. Just let us know where. But we're both, I agree, the mortgage refinance thesis is there. And I'd love to hear, in your view, like, what's the summary of the Better story from your perspective?
There's going to be this big refi as the rates come down. But I guess what really excited me as I dug into this story, there's a guy named Dan Lewis who had a position in Better as well. And so he had talked about it publicly, he'd gone on podcasts and talked about it, but it didn't really catch on. And I got introduced to him because someone who had another company that he was involved with wanted him to teach me about that other company, which he did. And it was an interesting company, but he said, I know you're like the Carvana guy now, and I like this other company that I'm telling you about. But to be honest, it's probably a 3X in the next few years. And if you really want a Carvana company, I've got a 100X company. And I was like, I'm all ears, Dan. Tell me about it. And it's this Better Home and Finance led by this guy, Vishal, who's known as a wild man. But
he's a founder. It's called Founder Mode, which is back now.
Right.
Vince Stanley, Stuyvesant High School, built and sold a company, took it public before, highly underrated. I wouldn't call that wild man. I call that raise money from SoftBank. Kleiner, go ahead.
Yeah. I think SoftBank for sure. And I loved him as soon as we had a Zoom, and then later on met in person and stuff. And I just totally gelled with Vishal, like, from the beginning. Like, he was telling me, because obviously I've gone through my own career ups and downs, and I could see that he had as well. And he stuck with it, and kept going. I think, though, if we had 50 people here in a room who were like semi-sophisticated financial investors, and we went through all 50 and we asked, have you ever heard of BETR? Probably like very few would say yes. And if we said, have you heard of Vishal? I think very few would say yes. But if we said, hey, do you remember that guy who fired 900 people on the Zoom call in 2021? Oh, 90%. Yeah, I remember that guy. Whoa, yeah, that's the guy. And that was a crazy story. That sort of has followed Vishal. And he only, when I first had a Zoom with him, and I was like, are you on X? And he's like, yeah. And he sent me his account. I think he only had, 50 people following him or something. He was just not that well known. And beyond that Zoom call. And so people took away from that, I don't know, he's cold and heartless and all this. And it was interesting chatting with him, how that whole experience, that was the time when I guess we were still at the latter stages of the Me Too stuff and everything. And I don't know, it was portrayed as if it was heartless.
It was cancel culture in
peak. And he told me that people on the board after that, they hired McKinsey to do an internal audit to make sure that there wasn't anything heartless going on. It made perfect sense to me when he explained it. They had this mortgage origination business that was doing $55 billion a year in mortgage originations coming into 2021. That basically overnight, after these major rate increases, went to basically a $5 billion origination run rate. So they had all these people working in India that they didn't need, who were pushing paper to fulfill those $55 billion in originations, and he just let them go.
Right. Rates went up. Blame the Fed, and JP Morgan, Wells Fargo did the same thing. Mortgages as our cyclical business. When rates go up and you can't refi, then you shrink, you get smaller, the call center and the mortgage servicing business. Obviously, it's done really well. I agree. When you think about the mortgage refinance space, there's Rocket, which has got a 45 times PE ratio, is the leader in the market, and there's limited competition, and they've got a clean AI experience run by Betsy, the avatar that interacts with you, clean closing experience. So no, I agree with your thesis. I think it's a good thesis. I think mortgage refinance in general is a good thesis. You've got Scott Besson's trying to talk down rates.
And what's, I guess, what was most exciting to me is he was a technical guy, as you said. He went to, how do you pronounce it? Stuyvesant High School in New York.
Yeah, one of the top 3 magnet schools in New York City.
So he was a smart guy. He told me, I didn't realize this, he had hired away the original programmer for Spotify who wrote the original music matching algorithm for Spotify to build his AI that was going to be mortgage matching, basically. And it was a much more complex problem than music matching to figure out how do I match this person to the lowest, cheapest mortgage. And so when he went through that culling of the head count to keep the business afloat, he basically doubled down on his AI investments at that time. And he built this Betsy and Tin Man platform to do the work that all these people outsourced to India had been doing in 2021 that he had to fire in that Zoom call. And what was more interesting is that he told me hey, actually we could have done all that. Now if rates dropped, we could have done that business amount that we did back then, but all through AI instead of with people.
Operating leverage.
Yeah, but even more so, we could have done even more, he said, in 2021, but we were human limited. So if we'd had this AI system back then, there was potential to do something like 250 billion in originations that year. And and by the way, in the meantime, we've also gotten into the HELOC business. We're also into something called the mortgage in a box business, where we basically take our direct to consumer kind of AI platform and we can sell it to mortgage brokers and people that want to match people up to the best, cheapest mortgages out there. So their TAM has increased incredibly.
Massive
and
TAM.
They have this business that's not human limited. So they're just waiting on basically rates to drop. And I remember one of the things he said on his calls, though, is that we don't even have to have rates go back to 2021 levels. We need them to go back to the 30-year average, which would probably be 200 basis points less than where they are now. And we will have so much volumes that we can potentially do that that's how you get to the really exciting numbers that I've sketched out in my pie in the sky $12,000 long-term price target, which some people didn't believe. Somebody messaged me today, is that 12,000 per share? I was like, what else is it going to be? Like, oh, anyway, it doesn't seem real given that it's a, whatever it is now, $60 stock or something like that. But that's potentially what could happen here.
Yeah, look, he's got a banking as a service story too, right? Helping banks adopt his technology so they can originate mortgages and be tech forward.
I think there's just, I think now he's a failed SPAC company. There's a lot of failed SPAC.
A lot of them, yeah.
Carvana wasn't a SPAC, but it was like this Walking Dead type public company. And I think what's really interesting about Carvana or Opendoor or Better is that, like, when you fall out of favor on Wall Street, you lose coverage, and it's almost like you don't even exist. And if you were private still, a bunch of VCs could get together in a back room and say, oh, we all know that Vishal is doing a great job and he's built this AI system. So let's all agree amongst us that we're going to keep the mark of this company at whatever it is. They say to themselves. In the public markets, no, everyone just moves on, and it's like you don't even exist. And when I shine a spotlight on these kinds of companies, I'm grateful that people pay attention, for one, but I think we've shown now, like in all these examples, like there's a lot of real unrespected value in some of these companies.
Yeah, it's a fallen angel. They were sponsored, they were taken public, lost analyst coverage. That's just how the markets work. And if that analyst coverage comes back, then the cycle can go in reverse and in a positive way.
Yeah. So I think, and Vishal obviously has to prove it now, and he's got earnings in early November. But he's being much more public than he was before. I think he's trying to meet the moment of this increased attention that's come his way, and I think he's doing a great job so far. So
he did a great job with Maria Bartiromo on Fox Business.
Yeah, for sure.
We have a question from the audience. It's my friend Sanjay. He was an executive at Top IB Trading Desk. Thoughtful guy. So, assume Fed funds get to 3.25% in 2026. What's your 12-month price target better?
I think, like right now, Figma just IPO'd, right? And Figma trades at this crazy high multiple of, I think it was 14x, maybe got as high as 19x forward price revenues. And they're only projected to grow their top line revenues next year. I think it's 40%, 30 to 40%. Whereas Vishal's already said we're going to double our revenue next year, and yet it's trading at like 1x forward priced revenue. So I said, if you gave it a Figure forward price multiple, it should probably deserves more than Figure does, given that they're going to double their revenues as opposed to whatever 30% increase them. It should be like a $600 stock. And so I've said, assuming that they have some good announcements and partnerships, like they've already hinted at when through their 8K filings, to me, I think this should be like $1,000 stock by like next year, as opposed to a $60 stock. So that's quite an increase. And people, a few days ago, like the stock was down 10%. And I'd get all these messages like, whoa, what's going on?
Right. The world is ending. Right. The sky is falling.
Then yesterday it was up 20% for no reason. And I got no direct message. Everyone was just silent. Oh, this is normal. Anyway, that's the way it goes. But yeah, I think this should be like a $600 to $1,000 stock by.
Got it. Tell us a bit more about kind of Eric Jackson, the person. You were inspired to go in front of Drake's home in the summer by your lonesome. You built this audience there. Where did that come from? Where did the idea of that?
I've had like a long and frankly like unsuccessful career to this point. I'm 53. I did a PhD in strategy and management at Columbia Business School during the dot-com era. I got bit by the technology bug by seeing that kind of firsthand. I decided I didn't want to be a business school professor, which is what most people in my PhD program did. I wanted to work in technology. So I got a job in Toronto working for a software company that was building like Siri type applications. It was a real company. So I was there for 4 years. I went through the whole like nuclear winter post.com. And my job was like to raise VC money, which was like really hard. We got Insight Venture Partners, which is like now a huge
top 10 VC
firm. Jeff Horning was on our board. He's now he's the guy who started Insight. Anyway, but then I helped my dad run a management consulting firm through some leadership issues he had. And then I got this idea of doing this like Yahoo social media campaign while I was living in Naples, Florida, just as like a retail shareholder. And then there was so much attention that generated at the time that a friend of mine in Naples was like, Eric, what are you going to do with all this attention? You should start a hedge fund. And that's when he gave me in the name of a lawyer and how to basically do it on the cheap. And so I tried to be an activist investor. I found out like with a couple $1 million, it's pretty hard to sway companies to listen to you without like billions behind you and stuff. So I muddled along. I did that for, I don't know, 10 plus years. It wasn't very successful. But then like this billionaire who, when I met him at Yahoo, he wasn't a billionaire. He remembered that I was pretty good at spotting kind of interesting companies very early on. So he said, well, how about I give you some money from my family office for you to manage for me? That's how I got started with EMJ. Did really well, but then had a bad 21 and 22, and then have been like bumping along ever since. So if you'd ask me like, oh, how's your career going so far? Like in the spring, I would say I'm a big failure and stuff. But then I decided to go public with my ups and downs and failures. And there were 2 Bloomberg articles that got written about me this year. And the first one, I bared my soul because I realized that I was wasting my own time, like trying to raise capital, because everybody always wants to know what your track record is. And so you have to send it to them, obviously. And so a lot of people, their mouths would like drop when they'd see this like volatility and ups and downs and stuff, or big drawdowns, and think I'm going to run for the hills. I don't want to invest with you. So I figured like better to just talk about it and the reasoning behind it. And then everybody who doesn't like that can self-select out. And then anybody who is still interested in me, hopefully
I appreciate your humility and authenticity too. And you're just laying it all out there so people can learn from you. That's, I think, something people appreciate.
Yeah, that's the thing I kept hearing. Wow, you're so authentic. And I was like, what do you mean? Is it because I talked about failing? I guess that makes you authentic if you talk about your struggles and your life and stuff.
The journey is the destination.
But the Drake thing, actually, it wasn't my idea. It was my 16-year-old son's idea. And so I think just the fact that like I was running this teeny hedge fund in Toronto, I had nothing to lose. So I adopted this more persona, like David Goggins. Somebody told me I needed to start like listening or watching or reading David Goggins, which is more of like very into like self-discipline, self-motivation. Nobody's going to come along and help you or drop a bag of money in your lap. You have to get up and do it yourself. You have to get yourself out of bed in the morning. You have to do everything to make it happen. And I adopted that personality on Twitter more. And then my son said to me in I guess it was the end of July, Dad, you keep talking about Opendoor as like being this great idea, but most people like don't watch CNBC or Bloomberg or stuff like that. They're just like going on about their day. And so how are you going to reach those people? And he said, you should go and do a video in front of Drake's house, because Drake's audience, they're like just every man, like they're not like financially sophisticated necessarily. And I thought, oh, that's interesting. And I thought, oh, there's a bunch of interesting angles with Drake, because at the time, like he was in this very public feud with Kendrick. But like everybody in the music industry anyway, it seemed, took Kendrick's side and backed away from Drake. And yet Drake has like the most top 10 singles like of any musical artist at like 88, versus like Taylor's like about a third of that, and the Beatles are like a third of what he has. So it kind of, I personally related to him, like having the people that have backed away in my life when I went through bad times. And I knew he was obviously a local Toronto guy. Everybody in Toronto loves him and is proud of him and stuff. And his house is very famous for being big and a monument to his success. And it's only like a 5-minute drive away from me. So I thought my son was saying like, oh, just go shoot a video and it'll be like a one-time thing. And I was like, okay, can you come and you film it for me? And he's like, oh, no, you can't do that's not how it works, Dad. You won't go viral if you just do a one-off video. You've got to do you have to basically do a video every day until something happens. Like you should try to get him to buy some stock in Opendoor. And so you say that you're going to be there every day, one day, two. I was like, oh, wow. Is that how?
Your son's a genius. I saw a survey. Go ahead. Yeah.
So anyway, like he watches enough TikTok to know that was going to be popular, and he was right. So I think there's been like, so it's day 59. And it's starting to get colder, so I can't wear my flip-flops anymore when I go there. But it's funny now, like it's morphed into now I have guest hosts some days, like today. But I think people really seem to like it, like in the Opendoor army, like they were like, it showed this guy, this hedge fund guy, he's like willing to do whatever it takes. Like he's consistent, and he doesn't let up. He's in this to win it. He's with us as shareholders until this outcome happens. So it's morphed into all kinds of different messages. but it's been fun for me, and it's generated like 7 million impressions of these different videos across different platforms. And there's so many people that are from outside of Canada or the US, like they're Mongolia, Antarctica, like all over Europe that are buying these stocks. And it's led me to realize that a lot of them are struggling, like they're not that wealthy and they're interested in stocks. And so I know that this is another angle. I haven't met Drake yet, but I've met his head of security, who's a guy named Bucky, who he came out on like day 10 and started talking with me and my son. And he was like, "What's this all about? Like, we've been watching you guys on the cameras like for these last 10 days. Are you talking about stocks here or something?" And we're like, "No, we're just talking, Bucky. I'm talking about one particular stock, like Opendoor. I think it's like a 100x opportunity. We really think Drake should put some money into it. And just imagine if he's worth $1 billion, like he could be like a multi-billionaire by the time this is done." And I'm going to
take it back to management.
Yeah. So first thing he said is like, "Hey, I'm going to buy this stock myself. Could I buy this through my brokerage account?" And I was like, "Yeah." He's like, "I'm going to put $10,000 on this." And I said, "If I'm right, Bucky, you're going to be worth $1 million in a few years because that's what it means to 100x." And he just lit up. He was like so excited. And then he says, "So the guy you got to talk to is this guy named Future." And I was like, "What? Future?" And he's like, "Yeah, Future. He's Drake's business manager. Future the Prince is what he goes by. And he makes all of Drake's business decisions, like OVO, like the clothing line and all this kind of stuff." And so he said, "I'm going to work to get you in front of Drake." But at the time, like Drake was touring in Europe. So I haven't yet met Future, but Bucky assures me that he's working on my behalf and he's going to make it happen sometime in the next, hopefully next week or so. And so I'll get my chance to make my pitch to Future about why I think Drake should be allocating at least some of his fortune towards stocks, because I know he likes sports betting and I know he likes crypto trading, but I'm going to say, hey, let's just take a little part of the annual sports betting budget and let's put it in a few good solid 100 baggers and we'll see what they say.
Use the word attention. The most valuable resource in the world is attention. And you remind me of this movie Forrest Gump, where he just gets on a mission and he goes and he's running. First, people think he's crazy, and maybe he's onto something. And you've built a community. You called it an open army, a better army. So I think you're onto something. I think social media activism is real. There are opportunities out there, and you can motivate, agitate for change. I'll have to send you an idea after this quietly to get your take on it. I think there are a lot of good opportunities out there. And if you look at digital assets, for example, that is community driven. And I think digital assets wouldn't have been successful without Twitter, no doubt. And now you're obviously focused on that opportunity and taking your kind of attention asset and focusing that on different areas. Do you want to close with any observations on the DAT or the digital asset?
Yeah, I'm really excited about this DAT that we're working on. So like the idea came because we were getting some great AI models. Like some of the models we built for crypto were like way better, more predictive, had much higher hit rates than any stock model that we were building. And I think it was because there's a lot richer information from the blockchain that you can pull and use as features to look at. And what struck me about all the Treasury companies that started to emerge just in the last 6 months, copycatting MicroStrategy, is that like a monkey could run them, basically. Like they would show up and they say, "Oh, we're a Bitcoin shop, or we're a Ethereum shop, or we're a whatever, Solana shop. And we're just going to raise money, buy Solana, raise money, buy Bitcoin, raise money, buy Ethereum." And so to me, like that's like what I will refer to on the roadshow as a Gen 1 Treasury company. That's not very interesting and doesn't really demand a premium MNAV. And it's interesting to me also that the most successful ones seem to be Tom Lee's or Dan Ives. So not like people with bigger megaphones.
Attention. Yeah, that's right. People with bigger followings. Yeah.
I would have thought a guy like Joe Lubin for SBET would have been like, "Oh, this guy's a co-founder of Ethereum. Oh, if you
that's the institutional underwrite."
Yeah. So
Tom Lee is the everything underwrite.
And yet,
CNBC, retail, and now institutions have to follow Tom as well.
But I do think the other thing about Tom Lee and others is that, and Trump really changed the game here, like after beating Kamala, is like to go on a 2-hour podcast and just converse as a real person. Like I think a lot of people didn't agree with everything Trump said, but they said he's a real person. Whereas
cut
Tom
through.
was all stage managed.
Yeah, the authenticity cut through. I agree. I think the Joe Rogan interview and also even like the McDonald's experience, I think social media drove that election outcome. So,
I think people see Tom Lee as authentic. Like they see
Yeah.
him as smart and authentic. Like he's trustworthy. Like he's not always right. He's obviously more bullish than anything else, but it pays to be bullish in the markets in general. And Dan Ives too, to a lesser extent. Anyway, my company, which I'm going to call it like a Gen 2 Treasury company, it's different in a couple of ways. It's a multi-asset crypto treasury, so it's going to acquire Bitcoin and Ethereum, but also what I call Carvana coins, which are altcoins that I think have been, like Carvana, disregarded and are sitting in the bargain bins waiting to be bought. And most people just aren't. If you talk to a lot of Wall Street or TradFi people, they'll say, everything besides Bitcoin or Ethereum, it's a scam. They're all scam coins. And there are lots of scams. And like, I'm not going to be buying.
Most are going to zero, just to be, But
there are some
have value.
Some quality.
Yeah.
So it'd be like if I said, I'm only going to buy the Mag 7. I'm just not. Russell 2000
Right.
is a bunch of scams. You're going to miss a Carvana if you take that point of view. So I think part of what I'm going to get paid for is to be the smart guy to find the Carvana.
Got it.
And then the second piece is the AI models will tell us when to DCA into these treasuries. So it wouldn't have been good. No Ethereum companies existed on Jan 1 of this year, but if any of them had, like Joe Lubin or Tom Lee, they would have been down 58% by April 23rd on their value of their Ethereum treasuries, because that's how much Ethereum dropped. So our models are going to tell us, like, hey, maybe it's not the best time to put your fiat that you just raised, 100 million fiat you just raised, into Ethereum or into Bitcoin, but maybe wait a couple of weeks to put it to work. And then also it's going to help us tell us when to hedge those treasuries. Just as for instance, like in 2022, Bitcoin was down 65%. MicroStrategy, if you held it for the whole year, you were down like over 75% on MicroStrategy. But the value of our treasury in our back testing would have dropped only 16%. We think we'll be able to tell a story of, hey, we're being a much smarter, different kind of treasury company into managing the value of our treasury over time. Therefore, we're going to grow it faster than anyone else. Therefore, we deserve the biggest NAV out there.
Got it.
So hopefully it'll start trading next month in November.
I might have another activist opportunity we're looking at. This Bain I'll give you the highlights of it. Bain Capital's on the board, has 4 out of 9 board seats, publicly traded, of course. They're paying out 14% interest rate to Bain. They are profitable at growing earnings at a double-digit rate. They should be able to refinance the debt at a much lower rate. Bain has essentially like a prepayment penalty, and they're like this vampire squid taking the cash flow of this business. It's a consumer brand. Many people have heard about it before, and it's down 70% from where it was just a handful of months ago. It dropped after Bain did this deal. Bain also got 20% warrants in the company, some at a penny strike, some out of the money. Essentially, the CFO and CEO, I don't know what the hell they were doing, but that strikes me as an activist opportunity where someone could get in there and say, here's a refinance package on the debt that's immediately accretive to earnings. Like half of the revenue that would otherwise go to earnings is going to service the debt, which is off market in any case. So anyway, it's an interesting pattern and setup like that in the healthcare category, but we're still doing some work on it. But really appreciate the time here today. Super insightful. Thank you, Eric Jackson. I will have to do it again soon. And I hope Drake joins you on the show. I know it's inevitable. It's only a matter of time. Before that happens.
I hope so. I got a good feeling still.
Terrific. And if you're listening, you can follow this at Lumida Non-Consensus Investing on YouTube, Spotify, Apple, or where you listen to your podcasts. Thanks, everyone. Thanks, Eric.
Thanks, Ron.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.